On April 29, 2026, Microsoft, Alphabet, Meta, and Amazon all reported their quarterly earnings on the same Wednesday afternoon. Every single one of them beat Wall Street expectations, and every one of them credited AI for the growth. But those record numbers revealed a new bottleneck. Despite the revenue growth, these companies are currently unable to keep up with user demand for AI. During Google's earnings call, Sundar Pichai admitted they are compute-constrained in the near term. He noted their cloud revenue would have been higher if they had the physical capacity to meet the market's needs. Big tech has shifted from purely digital services into the world of heavy industry. Their success is no longer tied to code alone, but to how quickly they can secure land and start pouring concrete. In just 90 days, these four companies spent roughly $130 billion on infrastructure. It is a massive land grab to fix their capacity deficit, costing nearly double what they spent in the first quarter of last year. To understand that scale, look at NVIDIA. These four customers spent as much on chips and data centers in 3 months as NVIDIA earned in the entire year of 2025. The pressure is coming from a $1 trillion backlog. Microsoft holds $627 billion in signed contracts they haven't yet billed, and Google's cloud backlog doubled in 1 quarter to $462 billion. The growth of the AI economy is now pacing itself against the speed of power grid connections and the time it takes for concrete to cure. To fulfill these commitments, the tech giants have entered a financial race to build out the physical world. These 4 earnings reports provide a look at 4 distinct strategies for surviving this infrastructure crunch. Microsoft is betting on agentic computing, where AI takes multi-step actions on its own. It's a strategy focused on software lock-in, with their AI business alone now hitting a $37 billion annual revenue run rate. Google is leaning into brute force physical scaling to clear their own backlog. Their cloud business grew 63% this quarter, but that growth is limited by how fast they can finish these windowless data center blocks. Google raised its 2026 infrastructure guidance to $190 billion to keep up. To fund it, they borrowed $31.1 billion this quarter, effectively taking on the debt of a small country to hold their ground. While Microsoft is hoarding future software contracts, Google is focused on pouring the concrete required to actually process them. Amazon appears slower on the surface, but they are building a massive hardware advantage. Their custom chip division, producing the Trainium and Graviton processors, is now at a $20 billion annual run rate. Amazon is vertically integrating its supply chain by signing multi-gigawatt power deals for these chips. Major players like OpenAI and Anthropic have already committed to using gigawatts of Trainium capacity through the end of the decade. This hardware-first approach is expensive. Amazon's free cash flow collapsed from $25.9 billion last year to a razor-thin $1.2 billion today, as they redirected almost every dollar into capital expenditures. Meta remains the outlier. Unlike the others, they don't yet have enterprise customers paying for AI directly. Their 33% revenue growth still comes almost entirely from their advertising machine. Mark Zuckerberg is using those ad profits to subsidize a $125 billion bet on consumer superintelligence. It is a moonshot strategy that relies on AI assistance becoming a daily habit for billions of people. In this landscape, Microsoft and Google are fighting over enterprise contracts. Amazon is buying the physical supply chain, and Meta is risking its ad empire on a consumer gamble. Despite their different strategies, all 4 companies share a single common thread: an AI startup called Anthropic. Anthropic is embedded across the industry. Amazon holds a massive stake, Google is investing billions, and Microsoft added Anthropic Monos to Copilot. Multimodal systems are the new default. Microsoft now auto-routes between OpenAI and Anthropic based on performance or price. This leverage has made Anthropic a central power in the market. Reports indicate the startup is now discussing a funding round that would value the company at $900 billion. True influence no longer belongs to the model builders alone, but to those who can lock those models into their own data centers. The metrics for tech dominance had shifted from tracking software metrics to tracking physical construction. Success is now measured in gigawatts and square footage. This change has split Wall Street. One side sees this $500 billion annual spending rate as a necessary response to $1 trillion in demand. The other side worries that we are witnessing a massive infrastructure overbuilt. The risk is a mismatch in timing. If infrastructure spending continues to climb while AI usage growth begins to slow down, these companies will be left with billions of dollars in depreciating chips that aren't paying for themselves. To survive that scenario, these companies need a margin cushion, the financial gap that allows them to absorb high costs while waiting for revenue to catch up. Google currently has a protective 32.8% net margin. Amazon, by comparison, is running a much riskier 10.8% margin, with almost no free cash flow left to spare. The winner of the next phase won't necessarily be the company with the smartest model. It will be the one with the financial padding to sustain these data centers, even if usage growth begins to plateau.